Good evening, everyone. And thank you for attending our 2015 market briefing. So the title of our briefing today is Stay the Course. Okay. In 2012, I'm sure you remember we made a fearless forecast that the PSEI would reach 10,000. And at that point, I'm sure you guys were probably, probably amazed, or you think, is that even possible? At the time, I remember the PSEI was trading at only 4,400. Here we are, 3 years later, and we're now trading at 7,400, 7,500. Seems like we are well on the way to hit 10,000. In 2012, we said that we'd hit 10,000 by 2020 at the latest. Okay, so now we are very much on track to hit it by 2020 at the latest, and hopefully we reach it much earlier than 2020. So tonight I will discuss why we believe that we are still on track. So first, let's talk about 2015. Why are we bullish about 2015? Okay. If you notice, if you read the papers, you will realize that there is really a lot of liquidity globally. Okay, and this liquidity will help drive the stock market higher. So if you look at the global map that we've prepared here, you will notice that it's only in the US where they are tightening the monetary policy. So in the US, the Fed ended QE3 in October. But look at what's happening in other countries. For example, in Europe, in June, the ECB cut the base rate by 10 basis points. And I think what's most important, or what's most memorable about the ECB last year was that it introduced negative deposit rates. Meaning that if you want to set aside your money now, you would actually have to pay the central bank money. So it's really discouraging people from spending money or from saving money. And then in September, it cut rates again. Okay, and then of course we know Japan also followed suit in October. So in October, Japan announced an increase in the size of debt purchases from 50 trillion yen to 80 trillion yen annually. And then, of course, China followed suit in November. It cut the lending and deposit rates by 40 basis points. Okay. So the next few days, people are expecting the European Central Bank to announce another round of quantitative easing, or they're going to pump more liquidity into the system. Bottom line is, in 2013, people were very much worried that the liquidity would be pulled off. But now that's not happening. In fact, we're seeing central banks actually putting in more money into the system. Okay, and today, we're not worried about inflation. In fact, the headline now is deflation. Deflation rather than inflation is now a bigger concern. So if you look at the chart on the left side, you will notice that except for the green line, all the lines are trending lower. And this is inflation for countries such as US, Europe, Japan, and China. Actually, Japan is trending higher. It's the green line. But they're targeting a 2% inflation rate. And it looks like after increasing, it has gone down. And what is making life more difficult for central bankers to hit a higher level of inflation is oil prices. Crude oil prices are actually down close to 50% from last year. So can you imagine if you're paying so much less for crude oil, obviously, inflation is not going to go up. Okay? So because of this, there is much less pressure for central banks to raise interest rates. Okay, so in the Philippines, liquidity will be there, will still be a main driver of the stock market. As you can see, the 10-year T-bond rate is also trending lower. And although it has inched up, it hasn't really gone up a lot. We believe that the domestic factors will also allow interest rates to stay low in the Philippines. Our government's finances remain very strong. Our government does not need money, actually. The debt level of our government has been going down, and deficit spending has also shrunk. Okay, we have a strong external accounts position, meaning we continue to have a lot of dollars in the system, thanks to the huge amount of OFW remittances and the strength of the business process outsourcing sector. And of course, last year we had another ratings upgrade. So we're actually now one notch above investment grade. And our banks actually don't want us to keep deposits with them. Because, I mean, they're only lending out 65% of what we've deposited with them. Which is why, they give us deposit rates of less than 1% at this point, because they really don't need our money. Okay, so, when you approach people and tell them invest in the stock market, usually they tell you, it's very expensive, I'm so worried. But nevertheless, despite the fact that the stock market may seem expensive from a historical perspective, because we're now trading at around 18 times PE, we are still more attractive compared to alternatives that are available. In fact, SDAs are not accessible to the regular retail investors anymore at this point. Okay, and here's another chart which I'd like to share to show to you why we don't believe in comparing the rules of thumb, saying that the PSEI has to be trading at 15 times PE. I mean, notice how the PSEI used to be trading at 15 times PE, but then in the past, if you do a spread of the earnings yield of the PSEI versus the 10-year bond rate, it was really much more profitable, actually, to invest in bonds because the spread was negative. Okay, meaning investing in bonds would have yielded a higher return versus investing in stocks. But now you can see that it's actually more profitable to invest in stocks versus bonds. Okay, so how can you even say that a 15 times PE is something that we should look forward to or that should be maintained? Okay. Okay, I know that this slide is very busy. Okay, it has a lot of numbers. But I just like you to focus on the second column, which shows the 2014 returns. Okay, it shows you the returns of the stock market arranged from the worst performer to the strongest performer. So the worst performer was Russia last year. Best performer was China. We're like the third best performer. And if you look at the 2014 PE column, we are actually one of the most expensive stock markets. Okay, whereas Russia, which is the worst performer, is actually the cheapest stock market. So my point is, what's more important actually is growth. Not saying that we shouldn't look for values, but rather than being too fixated on values, we should be also conscious about growth. And what I'd like to say is that 2015, if you look at the last two columns, although we are again one of the most expensive stock markets in the world, we are going to be one of the fastest growing economies also. Here, the consensus forecast is 6.1%, but the World Bank is forecasting GDP to grow by 6.5%. The IMF also today just came out with a statement saying that it's upgrading our GDP growth forecast to 6.4%. So really, we're going to be one of the fastest growing economies in the world in 2015. And that is really very exciting. Okay, another concern that people talk about when they think of investing in the stock market is the uncertainty about the next administration. Who will be the president after Pinoy? But I just like to point out that no matter who the president is, Filipinos always spend. Consumers are very resilient. They continue to spend during the term of President Cory Aquino. Average consumer spending grew by 4.2%. During the Ramos time, consumer spending increased by around 3.6%. For the term of Estrada, it was up 4.5%. Arroyo 4.3, Pinoy 5.6. I don't think it's going to change. Okay, so I'd just like to share with you this very beautiful infographics of the Filipino consumer. Okay, why are when we when we go to other countries and talk about the Filipino consumers, the foreign investors just fall in love with the story of the Filipino consumers. And this infographic summarizes why the Filipino or the foreign investors are so impressed. First of all, we have population growth. Our population is still growing. Okay, median age of 23, meaning very young, still starting to earn more money. Okay, and then 2015 is the year that we will be starting to enter the demographic window. And this is going to last 40 years. Okay, and what's so great about the demographic window? It's the 7.3% average GDP growth that follows. Because when an economy enters the demographic window, the average GDP growth during the first 10 years is around 7.3%, which is amazing considering that the global economy right now is only expected to grow by 3%. Okay, and why is this? Because we'll see the productive population growing by 48% during that period of time. Okay, and the resiliency of the Filipinos, thanks to the OFW remittances, which is now hitting 24 billion US dollars a year, and BPO revenues, which are expected to hit 25 billion US dollars by 2016. And this one last number, which I have not yet shared to you in the past, is the GDP per capita of the Philippines. Okay, right now our GDP per capita is $2,764. So what's the significance? Anecdotally, if you talk to fund managers who have experience investing in other countries, they will tell you the magic number for GDP per capita is 3,000. Okay, so give it a year or two, we're gonna hit 3,000 US dollars, and it means a lot of difference. They said at 3,000 US dollars, you'll see a lot more discretionary spending, people spending more on, say, cars, luxury items. So we're about to hit that tipping point anytime soon. Okay, and well, I'm not an economist. I don't know how to do econometric models, but this is an exhibit that I borrowed from a third party. Of all countries, it says that the Philippines will be one of the major beneficiaries of falling oil prices. Okay, at 0.6% of GDP for every $10 drop. So I think oil now is down by around $50 compared to last year. So if it stays lower by $50, that would be a huge boost to the GDP. Okay, and the reason why we will benefit from it is because our government does not provide us any subsidies for fuel prices. And we don't export any fuel anyway. We don't explore. We're not an oil exploration country. So any drop in oil price will definitely have a positive impact to the consumers. It will mean more money for consumers to spend, higher margins for corporates, which consume oil as raw materials or even for their day-to-day operations. Okay, so we're very positive also because of falling oil prices. And 2015 is going to be the second or the last year of President Noynoy Aquino's term. And government spending usually picks up a year before a presidential term ends or before the presidential election. So you can see here clearly the contrast between the spending growth during the last year of the term versus the term average. Except for President Corazon Aquino, all the presidents actually increased spending 1 year before the election year. Okay? Parang what's more important to them is legacy rather than saving money and stuff like that. It's going to be their last year. They might as well spend and leave a legacy because there's no re-election in the country anyway. Okay. And what about elections again? And all the political noise if you look at the left side, you will notice all the political noise that came about. 2013, of course, we had the PDAF scandal. We had the misuse of the DAP, okay? 2014, Revilla, Estrada, and Rile were arrested, and then there were attempts to impeach Pinoy, and then of course right now there's an ongoing investigation for the Vice President for plunder, no, and corruption. So a lot of political noise, a lot of reasons why you should not be investing in the stock market. But you know, in contrast, look at the right side. What have the foreigners been doing? Okay, the ratings agencies, notwithstanding all the political noise, have continued to upgrade the ratings of the Philippines. So in 2013, all three ratings agencies upgraded the Philippines to investment grade. In 2014, you know, this did not, I guess, catch a lot of attention, but in May of 2014, S&P upgraded us again, one notch higher above investment grade. And in December, Moody's also upgraded. So Moody's kind of agreed with S&P. And, you know, when S&P upgraded us, they made a statement saying that they are confident that the reforms that are being implemented right now will endure beyond the current administration, which is why they proceeded to upgrade the Philippines' credit rating. Okay, so we're increasing our PSEI target. So I know that during the last time we met each other, we said that our end 2015 target was 7.8. So we're now increasing it to 8,300. And the reason why we're doing that is because we believe that liquidity conditions have changed favorably, and this warrants a reduction in the risk-free rate. Okay. So essentially, you know, if interest rates go down, it just means that prices have more room to go up. Okay, because obviously there are less alternatives to place money. Okay, so you can see the red line is actually the Philippine interest rate. Okay, the blue line is the US interest rate. So we are concerned during periods such as the July period, if you'll notice, the two lines are becoming close to each other, meaning the spread is narrowing. So when the spread narrows, there is a tendency for investors to invest outside of the Philippines because the Philippines is becoming expensive relative to the foreign alternatives. But when it widens, it makes the Philippines more expensive or more attractive as an investment. So right now, the spread is actually pretty wide. So we're quite confident that even with our lower interest rate forecast, we are not being too aggressive. In fact, we're forecasting at a 10-year T-bond rate to be at 4.5%, which is right now significantly above the 10-year bond rate of only 3.6%. Okay, so now I proceed to your favorite section, which is our stock picks. Okay, so I'll talk about them one by one. Our favorite sector for 2015 is clearly the consumer sector. You know, the stars are aligned for the consumer sector. And we have a number of favorite stocks, so I'll start with DNL. DNL has been one of my favorite stock picks ever since, and it has actually performed quite well for us. I'm actually quite happy that it is correcting right now, and I believe that the ongoing correction is an opportunity for you guys to buy the stock. Okay, so DNL manufactures raw materials that are used by consumer companies, and the reason why I like it so much is because it focuses on specialized products. So this makes it less vulnerable to competition and price wars. And they have they recently consolidated one of their subsidiaries, which is Chemres, and we believe that this is going to be a value accretive consolidation for them. Okay, our target price is now $17.80 for the stock. Okay, another stock that we like, this is a new stock. It just had an IPO, I think 2 years ago, Concepcion Industrial Corp, CIC. So CIC is the market leader in air conditioning and refrigeration in the country. Okay, so it's the manufacturer of Carrier Aircon. Okay, and we expect it to benefit from the growing demand due to the large untapped market for air conditioners and refrigerator in the country. Believe it or not, a lot of Filipinos still don't have air conditioners and refrigerators. And of course, as Filipinos become more affluent, they will buy air conditioners and refrigerators. Okay, and we also expect Concepcion to enjoy higher margins because they have ongoing cost-cutting initiatives, and they are now focusing on rolling out higher margin models for their appliances. And they also have new businesses such as a tie-up with Midea and a joint venture for Otis elevators and escalators. Okay, and valuations are very attractive. Right now, consumer stocks are trading at an average PE of 24 times. Concepcion is only trading at 18 times PE. So we believe that this is still a very attractive consumer stock to buy. Okay, another stock pick. This is a new stock pick, GT Capital Holdings. Okay, this is the holding company for the T family's investments in Metro Bank, Toyota Motors, Federal Land, and Global Business Power. And the reason why we like GT Capital is because of Toyota Motors, or TMP. TMP will be a major beneficiary of the growing motorization of the Philippines and the weak yen, okay? So, believe it or not, the past 3 years, Toyota Motors sales have grown by 25% annually. And this is expected to continue going forward by around 18% annually. And aside from that, the weaker yen will benefit them. The yen has been very weak. They expect every yen depreciation of the yen relative to the US dollar to increase profits by 120 million pesos. Okay, and we know that the yen has depreciated quite a bit. I think last year it was doing 90-something yen to the dollar. Now it's 116 yen to the dollar. So that is quite a bit of depreciation for you. Okay, and for those who remember GT Cap when it IPO'd in the past, it was actually another proxy for Metro Bank. Okay, but that has changed. Recently, GT Cap has bought more shares in TMP, and of course, TMP has performed very well in the past, such that TMP now accounts for 30% of the net income of GT Cap and 44% of net asset value. So it accounts for a sizable portion of the company already. Okay, then we still like power companies, so we actually have 3 picks. Okay, my first 2 picks are EDC and First Gen. Okay, EDC is a pure play on renewable energy, and more than 80% of its capacity is secured with long-term take-or-pay contracts. Okay, in the past it had problems with the Bachman power plant, but finally this year they have completed the rehabilitation of Bachman. And this is expected to lead to a 27% increase in revenues and a 32% growth in net income for 2015. Okay, First Gen Corporation, okay, for those of you who might find EDC a bit pricey, because right now EDC is trading, I think, above our buy below price of 860, you may want to buy FGen instead. Okay, it's a cheaper way to buy EDC because FGen owns 49% of EDC. And of course, aside from EDC, there are reasons why we like FGen. The power generation capacity, for example, of its Santa Rita and San Lorenzo gas plants are also fully secured with long-term contracts. Okay, and it has 2 plants which will come online by 2016, and this will boost attributable capacity by 23%. Okay, and I mean, during the past few months, FGen has been an underperformer, but just today, there was a share placement. Okay, FGen was already able to raise 7.5 billion from a share sale. So we think that concerns of a share placement should no longer be a problem because they have already done the share placement. Okay, Aboitiz Power, we still like this stock. As we've discussed previously, it's the largest power distributor in Visayas and Mindanao, and it also has a growing portfolio of power generation, which includes several renewable energy plants such as hydro plants. Okay, a big portion of their power generation capacity is also contracted at around 89%. And after falling in 2014, we expect profits to rebound in 2015 by around 13% as their new plants start operating. And the stock also provides an attractive dividend yield of 2.5%. Then, of course, we also like Cebu Pacific. Okay, we believe Cebu Pacific will be one of the major beneficiaries of falling oil prices. Cebu Pacific is the market leader for domestic travel with a 64% market share. And although we know that there are a lot of bad publicity lately, like the removal of the fuel surcharge and the 52 million fine for the holiday incident, we believe that these negative developments will have a minimal impact on profitability. In our forecast, we see profits more than doubling for 2015 to around 6 billion pesos. Okay, and share price appreciation potential is, of course, quite significant still. Okay, Metro Bank, we continue to like Metro Bank. Okay, it's the second largest bank in terms of assets and deposits, and it is now trading at only 1.5 times price to book value versus 2 times price to book value for BDO and 2.4 times price to book for BPI. We know that the reason why Metro Bank has been sold off or is underperforming relative to BDO and BPI is because of concerns of share placement. Okay. However, the sell-off that has taken place, we believe, is too much. It's unwarranted. Okay, because outside of the capital raising issue, we view Metro Bank still to be a good bank, enjoying an ROE of around 12.8% as of the first 9 months of 2014 and exhibiting a loan growth of 21%. Okay, other stocks that we like, SM Prime, we continue to like SM Prime. I think it has underperformed because of concerns as a big residential property developer, and of course their focus on the below 2 million peso segment, which you know, people talk about a glut, they think about the below 2 million peso segment. But nevertheless, I think people are forgetting that SM Prime is still predominantly a mall operator, a Philippine mall operator at that, with 70% of operating income and 64% of net asset value coming from the malls. And this makes it a good proxy for consumer spending. Also, another reason why the company has underperformed, because of concerns of share placement. However, the possibility of a share placement should no longer be a concern, as the company already raised 18 billion pesos through a share sale last November. Okay, and finally, we like Ayala Corp. Okay, it's among the oldest and most diversified holding companies in the country. Okay, with a reputation of excellence given its investments in several market leaders. You have BPI, Ayala Land, Globe, and Manila Water. Okay, diversification into power and infrastructure will help drive its long-term growth and increase defensive sources of income and cash flow. So we now know that Ayala Corp is aggressively expanding its power portfolio, and it's actually one of the most active participants in PPPs. Okay, so this is a summary of our stock picks for you, 10 stocks that we like. Just as a note, if you're going to buy EDC or FGen, please don't buy, or let's say you're going to pick 2 stocks to buy, please don't buy EDC and FGen together because they are very much related to each other. Okay, so you are not exactly diversifying when you buy EDC and FGen. Either you you only choose one between EDC or FGen. Or you reduce your size if you want to buy both, then buy another stock. Okay? Okay. Okay, before I end, I just like to point out the risks for 2015. Okay, although we have a very bullish view on 2015, it's not going to be an even rally. We'll see a lot of volatility. I mean, there are a lot of things going on. This is a liquidity-led rally, and if anything, if there's anything we learned about 2013 is that liquidity rallies tend to be fickle. They tend to be volatile. News of, say, maybe oil prices rebounding significantly, or news of a Greek exit could lead to huge market sell-offs. Okay. And of course, we're seeing a lot of capital raising going on. A lot of companies are taking the opportunity to sell shares to raise capital at this point. In fact, just today, there was an announcement that JG Summit is actually doing a share placement. So usually news of capital raising will lead to sell-offs in share prices. But then again, we have to be a lot wiser when we read the news of share placements and we see volatility. Please do not be afraid of them. Try to judge whether the sell-offs are warranted. And if these sell-offs are not warranted, we should view them as opportunities to actually buy the stock. Okay? Like even news of share placements. If stock drops on speculation of share placement, if you are a long-term investor, it is actually an opportunity for you to buy the stock. Okay, so in summary, we believe that the market will continue to move higher in 2015, bringing the PSEI well on its way to meet our goal of 10,000 by 2020 at the latest. Okay, so we're not saying 10,000 at 2020. This is the latest that we will hit 10,000. We may actually reach 10,000 earlier than 2020. Okay, the most important reason why the stock market will continue to go up is ample liquidity, both globally and domestically. The resulting drop in interest rates makes stocks more attractive compared to other liquid investments, despite the PSEI's relatively expensive valuation from a historical perspective. The other reasons why we expect the market to continue going up is the Philippines' above-average economic growth outlook for this year and beyond, and favorable impact of falling oil prices on consumer spending, and expectations that reforms to address the shortcomings of the country will endure beyond the current administration. Okay, given our view that liquidity will drive the stock market higher, we increased our end 2015 target from 7.8 to 8.3. And we just like to reiterate our top picks for 2015. They are DNL, CIC, GT Capital, Aboitiz Power, EDC, First Gen, Metrobank, SM Prime, Cebu Pacific, Ayala Corp. Risks for 2015 include uneven share price appreciation, volatility, and share placements. So that ends my presentation. Thank you very much.